Hi, welcome to the Financial Fox. I'm here with the market guru Zachary. And joining us today is Paul Atherley, the CEO of Berkeley Energia, the Australian and London AIM-listed company that is operating the largest European uranium project in Western Spain. Paul, nice to have you on the Financial Fox.
Nice to be here, Steph.
So, Paul, you run one of the few companies operating in the uranium space on the London market. So, the first question that comes to my mind, considering the uranium market and the uranium price, is why investors should look at uranium now? What is the opportunity?
Because uranium prices are at 12-year lows, and really, if you're looking at cyclical investment, the best time to be investing in a stock is when you're pouring concrete at the bottom of the cycle. And we don't know exactly when the uranium prices will recover, but what we do know is most of the producers, 40 to 50% of the producers today, can't make money at these levels. So we know it's unsustainable. So whilst we're building the operation, we can make money at these levels, but we make even more money when the uranium price recovers. So a very, very good time to be investing is at the bottom of the cycle, rather than, say, investing at the top of a cycle.
This is what people were saying, in the mining sector, the other part of the mining sector, in 2013 or 12, 13, 14, 15. Finally, it did happen, but because production costs were higher than the value of the underlying. But isn't it better to wait for some kind of driver, some news for uranium before getting in?
Not really, because we're seeing the key drivers, the key indicators, and when you're going to see the move, is what we call supply-side destruction. So we've seen the world's biggest producers, as Kazakhstan, cut production by 10%. We've seen the world's biggest listed producer, Cameco, close mines. These are the signals you see. This is the market telling you that this current price is unsustainable. And so the next thing that happens after that, you'll see some price recovery. So now is a very good time.
Okay, Paul, so let's look at your Salamanca project in West Spain. The mine is gearing up for construction, which is expected to happen around the end of the summer. When are you expecting, is all on track, and when are you expecting production to start there?
Yes, we're well advanced. We raised some money at the end of last year to purchase, one of the main items to purchase was the crushing circuit. That's now been fabricated. It's in Madrid as we speak, ready to move to site, and as you say, we'll be pouring concrete, pulling steel out of the ground, building the crushing circuit. That construction period takes about 12 months, and then there's about 6 months thereafter of commissioning. So we're aiming to be in production towards the end of 2018, going into 2019.
Okay, and regarding the funding, so last year you mentioned about a joint venture partner, strategic investor, coming in approximately mid of 2017 to address the funding. Now, you indicated that the cost was around $100 million, right? So you have got around $30 million in the bank, so you will need around 65, 70. Are you on track to bring in this strategic investor? What kind of investor are you looking at?
Yes, that's all correct. We're now in the final stages of what's called our front-end engineering design, which will firstly confirm that $100 million capital cost. So we're in that process of just firming up the actual cost, so we can come back to shareholders and say the $100 million that we told you it's going to be that number or very, very close to that number. The second thing is, you're exactly right. We're short of $65 million US, and as we've advised, we're well advanced with a number of parties, a couple of whom are strategic, as you indicated, and we hope to be in a position to announce that in the next few weeks. Now, I want to be very careful about that. Say a few weeks, it might be July, it might be August, but certainly everything we've indicated, we said the middle of 2017, we get the feed numbers out, get that confirmation. The processes with the strategic partners and the financiers are well advanced. So hopefully we can sign that up and get that announced.
Yeah.
I just want to ask what the demand is for it, because we've talked about the price. Obviously, the price is related to demand, but what is it? I mean, what is the demand profile for uranium, especially given that we know that there's a massive crisis in energy, there's a lack of energy for all purposes across the world, especially in the developing world. How is that proceeding?
I think the way to look at it is that there's a massive demand for clean energy, i.e. zero carbon. And if you think about it, the only baseload, scalable, clean energy right now is nuclear. I was in Spain the other day, and at any point in time, they've got around 20% of their electricity generated from 7 nuclear reactors, providing clean baseload energy. And if you're going to meet the 2030 or 2050 carbon targets, you can keep expanding renewables as much as you like, but at the end of the day, when the wind doesn't blow and the sun doesn't shine, you need a base load. So it's nuclear and renewables. So in answer to that question, where we're going to get that from, there are over 60 nuclear reactors being built around the world today, 20 in China. India's just announced another 10. So the way to think about it is any modern developed economy will have somewhere between 10 and 20% of its base load from nuclear. In fact, the European Union, one of their agencies called FORATOM, have said for the European Union as a whole to meet its to decarbonise the economy by 80% by 2050, it needs more nuclear, not less. So I think you'll see that as we settle down into policy settle downs around the world, in answer to your question, how are we going to meet those targets? Nuclear is going to sit for developed economies somewhere between 10 and 20%.
So let's look at again at the Salamanca. So you have already one offtake agreement in place, correct? And you also said you were going to look to sign up some other offtake agreement to secure at least 1 year of production of your uranium. Can you maybe explain a little bit about the terms of the first offtake agreement, and also if you're still on track to get the other offtake agreement, and if you can say which are the parties?
Yes, I can't answer the last part because A, it's not announced, and B, it's commercially in confidence. But I can give you some idea for the first two parts of the question. First of all, the actual structure of these offtake agreements, they're not fixed price. They're split roughly. Half of them will be on a near-term price that escalates every year, so the price goes up. And secondly, for the other half, there will be a cap and a floor. So if the uranium price goes strongly north, which we think it could do when the market adjusts to the sort of commercial realities, the uranium price, let's say it spikes up to $60 a pound, then we capture part of that.
Right.
Equally, if the uranium price stays low, we've got a floor on part of it. So that's in answer to how we participate. The second part of your question relating to who the parties are, I can't name at this point, but I can indicate to you there is 2 large groups of nuclear reactor utilities who are recontracting. One is from the United States, and the other, in 2 years' time, will be the European Union. So right now, the biggest demand we're seeing is the United States utilities who this year are full up in terms of the contractual arrangements, but over the next 5 years, they fall down to 20% coverage. So they're looking to recontract. And what's attractive to them about us is we're not in Kazakhstan, Niger, or Russia, who currently supplies 60% of the European Union. We're actually a OECD-based producer. So they're very happy to diversify away from their existing arrangements and come to us.
Okay, that's great. So what would you be the peak production, and also what will be your target for production for the first year?
We're looking peak production 4.4 million pounds of uranium. The first year will be around 2 million pounds of uranium as we ramp up to the 4.4. And one question we get asked a lot is what level of coverage in terms of offtake will we look to put in place? And the answer is we're looking to commit $100 million to the project to put it into production. We'd obviously like to get a high level of coverage during that period of capital recovery. And thereafter, as we think the market will get much stronger for uranium, we'd like to see possibly less coverage and more exposure to the spot price.
Just give an idea of where Berkeley could go. I mean, at the moment, let's say we're a small cap, modest company. Once everything is going in, 2-3 years' time, what are we? Mid cap, FTSE 100? I mean, what's the size of the project, and what's the ideal scenario?
Well, to give you some idea of the cash flows, probably the least optimistic of all the analysts who cover us is Ben Davis from Liberum, and Ben is quite not particularly optimistic on the uranium price and not particularly optimistic on us in terms of he puts in a lot of inflation and factors into his analysis. But even he is talking about us generating over $150 million US a year in about 3 years' time. So this is a very strongly cash generative project off a very low capital base. Remember, we're only putting $100 million in up front, and then there's some progressive capital goes in later. But off that, we're generating $150 million a year.
In fact, one of the points you always stress is the low cost of your operation. So why that?
Why is it low cost?
Yeah,
There's two aspects to low cost, as I think most of you know, that most junior mining companies will talk about their asset being able to produce, being in what they call the lowest quartile. We're definitely in the lowest quartile, we're near the bottom, and part of the reason is because our ore body is so close to the surface. It's got great metallurgy, great mining characteristics, that's a low strip ratio, and very, very good production costs. The operating costs are very, very low as a result of all of that. But the second element, which is really important, is that generally what goes with low operating cost is you'll have a high capital cost and a long lead time. We don't have either of those. As we say, we're doing infrastructure now and we're moving into main construction. But we also have this advantage in the European Union, is that we've got roads, power lines, all the facilities we need. And in fact, if our upfront cost is $100 million, if we were perhaps somewhere else in the world, didn't have that, we'd be closer to $250 million upfront. So we've got a $150 million dividend, basically, from the European Union's infrastructure development that allows that community, this project, to go ahead.
And also you are employing quite a significant number of people locally as well.
We are. We're up to nearly 70 now. When the crusher comes to site, it will move quickly to 150. Peak construction next year, it'll be around 700 people. And this is in an area where Provence lost 25,000 people last year. They were moved away looking for work. And certainly in the Salamanca area itself, they lost 1,500 people. So we talk about rejuvenating the local community. The two local villages, we've trained 115 people from the two local villages, and of them we're employing quite a few. So we're genuinely doing what mining companies do, go to remote parts of the country, invest lots of capital and generate jobs, spend money into the local businesses and pay lots of taxes.
I just want to step back from the immediate focus, but just, I mean, you're an entrepreneur, you're a businessman, you've been around the block a few times. Are you happy with where Berkeley is at this stage? I mean, to the mid-2017, do you think you'd be here? Do you think you'd be further across the road? How would you rate the experience, let's say?
When you step back and you say that in effect, the discovery holes for this deposit zone of 7 was of the extension to which made it the ore body it is today, was in September 2014, and we're going to be in production in 2019. That's 5 years. That's 5 years in a developed economy. That's fast. That's fast by any. You can normally allow for a decade. So if we get there in 5 years, that'll be quick, and we'll be very, very pleased with that.
And do you feel, I mean, you always seem to be very chirpy and upbeat. I mean, is there pressure, is there stress in this job?
Of course, but we thrive on it. There are challenges to be overcome. But the rewards are building things, pouring concrete, steel work coming out of the ground, 70 people employed. One of the things that I'm really excited about is 37% of our employees are women. We have very, very talented female geologists, 2 very talented female mining engineers. I personally, through my school, sponsor STEM for girls to go on and study science, technology, engineering, maths. So they're the things that we get rewards out of, seeing things built, seeing people pushing their careers forward and giving opportunities.
Okay, Paul, exciting times ahead for Berkeley Energia. Thank you very much for being our guest.
My pleasure, Steph.
This is all for the Financial Fox. Make sure you keep an eye on Berkeley Energia and don't forget to subscribe to our YouTube channel. Bye.